Welcome to the Inspired Podcast. All right, so today we're going deep on John C. Bogle, the founder of Vanguard, and really kind of like the creator of the index fund as we know it.
Really, the OG index fund guy.
Yeah, and when you think about it, it's kind of crazy that one person really shifted how millions of people invest.
It's true, and he was so adamant about this idea,
Right.
that it was just the common man,
Right.
that should be able to invest in the market and actually get market returns.
Right, and not be taken advantage of.
And not be taken advantage of, exactly.
Right, and it's something that now just seems so obvious.
Right.
But at the time,
It wasn't obvious at the time.
it's revolutionary.
Oh, yeah, people thought he was crazy.
Right, and we're going to talk about all of that.
Yeah.
We're going to unpack his core ideas around low-cost index funds and why a long-term approach is so powerful for building wealth.
Yeah.
And this is the thing that's so wild, is that he passed away in 2019. Yeah.
But these ideas,
They're timeless.
they're timeless. They're more relevant now than ever.
Exactly. And in fact, I think that with everything that's going on in the market today,
Right?
with all the hype and speculation,
For crypto bros and all that.
yeah, all of that, it's even more important, I think,
Right.
to revisit these principles.
Yeah, yeah.
To go back to the basics.
Yeah, and he's got this whole community of Bogle heads who swear by this wisdom. And so our mission in this deep dive is really simple. Just like Bogle's philosophy.
Yeah.
To just grasp his straightforward approach and see how you can apply it to your own life.
And see how it resonates with you.
Right, exactly.
Yeah.
So how about we start with something Bogle called the paradox?
Okay.
And this is something that he observed, and I think it's something that resonates with a lot of people who are listening right now.
Yeah.
He noticed this big difference between the average return of the entire stock market and what the average investor actually earns.
And it's like almost like the market is climbing this hill and the average investor is only making it part of the way up.
Right.
So why do you think that is?
Well, I think that that's the central question that Bogle was trying to answer.
Right.
And I think the simple answer is that it's because of behavior.
Right.
It's not because of the market itself. The market itself actually provides pretty good returns over long periods of time.
Right.
But investors don't get those returns. And the reason for that is a few things.
Yeah.
One is fees. They pay high fees to active managers, to mutual funds, to advisors.
Right.
And so that eats into their returns.
Right.
The second thing is trading costs. So every time they buy or sell a stock, there's a commission. And so that also eats into the returns.
Right.
And then the third thing is trying to time the market. So they're always trying to, jump in when the market's going up and jump out when it's going down.
Right.
But that's really, really hard to do. And it's almost impossible to do consistently.
Right.
And so they end up buying high and selling low. And that also, detracts from their returns.
Yeah, that's kind of like the classic investigate.
The cardinal sin.
Sin, yeah.
Yeah.
Buy high, sell low.
Exactly.
So Bogle's key insight here is really the importance of just having a long-term mindset.
Exactly.
And having realistic expectations.
Yeah.
And that it's not about getting rich quick.
Right.
This is about steady, consistent growth that happens over decades.
Exactly.
So have you ever felt that urge to make a short-term move based on something that's happening in the market?
Absolutely. I think it's a natural human instinct.
Right.
To react to what's happening around us.
Right.
To what we see on the news or what we hear from our friends. And so it's very easy to get caught up in that.
Right.
But Bogle's point was that you have to resist that.
Right.
And you have to focus on the long term. Because over the long term, the market has always gone up.
Right. And as long as you can stay in it.
Exactly.
And ride out the dips.
Exactly.
Right.
Stay the course.
Stay the course.
As he would say.
That's right. Yeah. So Bogle also debunked what he called the grand illusion.
Okay.
And this is this idea that you can consistently beat the market.
Right.
By picking the right stocks or the right fund managers.
Yeah.
So tell us a little bit more about why he was so skeptical of that.
So the grand illusion is this belief that you can find, a manager or a system that can consistently beat the market over a long period of time.
Okay.
And Bogle said, that's just not possible.
Right.
Because the market is so efficient that all of the information is already priced into the stocks. So even if you have, a really smart manager, they're not going to be able to consistently find stocks that are mispriced. And so they're going to end up just matching the market.
Okay.
Or even underperforming the market because of the fees that they charge. So his argument was, why bother trying to beat the market when you can just buy the market?
Right.
And get the market return.
And that kind of goes back to the paradox, right? That it's not even that you're just not beating the market. You're actually doing worse than the market.
You're actually doing worse than the market.
Right.
Yeah.
So have you ever tried to pick your own winners? And how did that go?
Not well.
Yeah.
I've done a lot of investing over the years,
right.
and I've made a lot of mistakes,
right.
and I've learned a lot of lessons,
right.
And one of the biggest lessons I've learned is that it's really hard to pick stocks, and it's really hard to time the market.
It is. So if trying to beat the market is this tough game that we're talking about, what was Bogle's advice instead?
Well, his advice was to buy index funds.
Okay.
And so an index fund is a type of mutual fund.
Okay.
That simply tracks a market index.
Okay.
Like the S&P 500.
Okay.
So if you buy an S&P 500 index fund, you're essentially buying all 500 stocks in the S&P 500. And you're doing it in a very low-cost way.
Okay.
Because index funds are passively managed.
Right.
Which means that they don't have a bunch of managers trying to pick stocks. They just track the index.
Right. So they're not doing all the research and they're not.
Exactly.
Right.
They're not doing all the research. They're not paying all those fees.
Right.
They don't do all the trading.
Right.
So their costs are very low.
Okay.
And that means that more of the returns go to the investor. So Bogle's argument was that index funds are the best way for most investors to invest in the stock market because they're simple.
Okay.
They're low cost.
Right.
And they're effective.
Okay. So you're basically guaranteeing yourself the market return.
Exactly. Yeah.
Have you ever considered using these in your own portfolio?
Well, I actually only use index funds in my portfolio.
Okay.
I've been using them for many years.
Okay.
And I've been very happy with the results.
Okay.
I think they're a great way to invest.
Okay.
And I think that Bogle was right.
Right.
They are the best way for most investors to invest.
So it sounds like you're all in on index funds.
I'm all in.
Okay.
Yeah.
But Bogle had some other advice for investors.
Yeah.
In addition to telling them to invest in index funds.
Yeah.
And he actually has 10 simple rules for investment success.
Right.
So let's go through those.
Okay.
And the first one is reversion to the mean.
Okay.
So what does that even mean?
So reversion to the mean is a statistical concept.
Okay.
That basically says that over time, things tend to average out.
Okay.
So if something is performing really well, likely to come back down to earth. And if something's performing really poorly, it's likely to come back up. And so Bogle's point was that, investors should be aware of this. They shouldn't chase performance. So if a stock or a mutual fund has been doing really well, that doesn't mean it's going to continue to do well.
Right.
In fact, it's more likely to do worse going forward. Yeah.
So basically, don't get caught up in the hype.
Yeah, don't chase performance.
Don't chase performance.
Stay the course.
Right. And so are there any examples of this that you can think of, like investments that have done really well and then regressed to the mean?
Oh, there are tons of examples. The tech bubble in the late 90s. The housing bubble in the mid-2000s. These are all examples of assets that got way ahead of themselves.
Right.
And then eventually came back down to earth.
Right. And then we're seeing that now, too.
Going now, too.
Right, with certain sectors.
With crypto, with tech.
Yeah.
And so
it's a cycle that just continues to repeat.
Yeah.
Okay.
And Bogle's point was that, if you could just avoid chasing performance, you can avoid a lot of pain.
Yeah. So that's his first rule. Remember reversion to the mean.
Yeah.
What's the second rule?
The second rule is time is your friend, impulse is your enemy.
Okay.
And
that's not just for investing.
That's for life.
Right, that's for life, right?
Yeah.
So what does that mean in terms of investing, though?
So in terms of investing, what it means is that the longer you stay invested, the more time you have for your money to grow.
Okay.
And the more time you have for compounding to work its magic.
Right.
If you're constantly jumping in and out of the market, if you're reacting to every little bit of news, if you're letting your emotions get the best of you, you're going to sabotage your return. So you need to be patient.
Patient, right?
You need to stay the course.
Right. And not
react to every little blip in the market.
So the third rule.
The third rule is buy right and hold tight. Yeah.
But what does buy right mean?
So buy right means two things.
Okay.
One, it means buy low-cost index funds, as we talked about before.
Right.
And two, it means buy a diversified portfolio.
Okay. So don't put all your eggs in one basket.
Exactly.
Okay.
So you want to own stocks.
Right.
You want to own bonds.
Right.
You want to own real estate.
Right.
You want to own commodities.
Right.
You want to own a little bit of everything.
Okay.
And you want to do it in a low-cost way.
Okay.
And so that's what buy right means.
Right. So that's how you kind of create your foundation.
Exactly.
And then you hold tight.
And then you hold tight.
Right.
Yeah.
So the fourth rule is?
The fourth rule is minimize the croupier's take.
Okay. So explain what that means.
So the croupier is the person who runs the casino game.
Right.
And the croupier's take is the house edge.
Right.
So every time you play a casino game, the house has an edge. And that means that over time, you're going to lose money to the house.
Right. And so in the investment world, the croupier's take is the fees that you pay.
Yeah.
Right. So
how do you minimize the croupier's take when you're investing?
Well, you minimize the croupier's take by investing in low-cost index funds.
Okay.
As we talked about before.
Right.
Index funds have very low fees.
Right.
And so that's the best way to minimize the croupier's take.
Okay. The fifth rule is taxes are costs too.
Okay, so explain that. Yeah. A lot of people don't think about that.
A lot of people don't think about that.
Right.
But taxes are a very real cost.
Right.
And they can eat into your returns.
Okay.
Just like fees can.
Right. So how do you minimize the impact of taxes on your investments?
So there are a few things you can do.
Okay.
One is to invest in tax-advantaged accounts.
Okay.
Like a 401k or an IRA.
Okay.
Two is to invest in tax-efficient investments.
Okay.
Like index funds.
Right.
And three is to hold your investments for a long time. Because the longer you hold your investments, the less you'll have to pay in taxes. Yeah. And so those are just a few things you can do.
So the sixth rule?
The sixth rule is the relentless rules of humble arithmetic.
Okay, so explain that one, because that one sounds a little bit complicated.
So the relentless rules of humble arithmetic are basically the laws of compounding. Compounding is this idea that when you earn interest on your money, that interest then earns interest.
Right.
And then that interest earns interest and so on.
And it kind of snowballs over time.
And Bogle's point was that, compounding is a very powerful force.
Right.
And it can work for you.
Okay.
Or it can work against you.
Right.
So if you're paying high fees, compounding is going to work against you.
Right.
Because those fees are going to eat into your returns. But if you're investing in low-cost index funds, and you're holding them for a long time, compounding is going to work for you because your returns are going to compound and grow.
Right. And so really all of these rules kind of come back to that.
They all come back to compounding.
Right.
Yeah.
Minimize fees.
Right.
Hold for the long term. Don't try to time the market. Exactly.
Yeah. And then you let compounding do its magic. Right. So the seventh rule is beware of fighting the last war.
So beware of fighting the last war means that, you shouldn't base your investment decisions on what's happened in the past.
Okay.
Because the past is not always a good predictor of the future.
Okay.
And so, Bogle's point was that, investors often make the mistake of chasing performance.
Right.
So they see something that's done really well in the past and they think, oh, I'm going to invest in that.
Right.
But that's not always a good idea.
Right.
Because what's done well in the past may not do well in the future.
Right. And so are there any examples of that you can think of?
There are tons of examples.
Right.
In the late 90s, tech stocks were doing really well.
Right. And so a lot of investors piled into tech stocks. And then the tech bubble burst. A lot of investors lost a lot of money.
Right.
And so that's just one example of fighting the last war.
Fighting the last war.
Right.
Yeah.
So the eighth rule is the hedgehog beats the fox.
Okay.
So what does that mean?
So this is an analogy that comes from a philosopher named Isaiah Berlin.
Okay.
And Berlin said that there are two types of people in the world.
Oh.
There are foxes.
Okay.
And there are hedgehogs.
Okay.
And foxes know many things.
Okay.
But hedgehogs know one big thing. Bogle's point was that in the investment world, the hedgehogs are the index fund investors because they know one big thing, which is that the market is hard to beat.
Right.
And so they just buy the market.
And They hold it for a long time.
Okay.
But the foxes are the active managers who are trying to beat the market.
Right.
And they know many things.
Right.
They know about,
right.
Economics, accounting,
right.
and finance. But they don't know one big thing,
right.
which is that the market is hard to beat. Bogle's argument was that the hedgehogs will outperform the foxes over the long term. Because the hedgehogs are just buying the market.
Right.
And they're not paying all those fees that the foxes are paying. And so that's why the hedgehog beats the fox.
Okay, so basically be the hedgehog.
Be the hedgehog,
right.
Yeah.
So the 9th rule is if you don't peek, it's in your interest not to look.
Right.
So what does that mean?
So what that means is that, you shouldn't be checking your investment every day.
Right.
Or even every week.
Okay.
Because the more you look at your portfolio, the more you're going to be tempted to react to the short-term fluctuations in the market.
Okay.
And so Bogle's point was that, you're better off just setting it and forgetting it.
Right. Just not looking at it.
Yeah.
Right. And so
just let it grow.
And so how often do you look at your portfolio?
I look at my portfolio maybe once a quarter.
Okay.
And that's it. And so I'm
not tempted to make any changes or anything?
No, because I know that the market goes up and down.
Right.
And I'm in it for the long term.
Right.
And so I don't need to react to every little blip.
So the 10th rule?
The 10th rule is stay the course. And this is really the most important rule.
Okay.
Because if you can't stay the course, you're not going to be successful as an investor. What stay the course means, you need to have a plan.
Right.
And you need to stick to that plan no matter what.
Right.
So the market's going to go up, the market's going to go down, but you need to stay the course.
Right.
And you need to stick to your plan.
And that's easier said than done sometimes.
It's very hard.
Right. It's easy to panic.
It's very easy to panic when the market's going down.
Right. And then it's easy to get greedy when the market's going up.
Exactly.
Right.
Yeah. But if you can just stay the course.
If you can just stay the course, you'll be fine.
So in a nutshell, I think the key takeaways are that, investing is not that complicated.
Okay.
You don't need to be genius.
Right.
To be successful.
Okay. Yeah.
You just need to follow a few simple rules.
Okay. Right.
And those rules are buy low-cost index funds.
Okay.
Diversify your portfolio.
Okay.
Hold your investments for a long time.
Okay.
And stay the course.
Okay.
And so if you can do those things, you're going to be very likely to be successful as an investor.
Okay. Right.
And, Bogle was a living example of this.
Right.
He followed his own advice.
Right.
And he did very well.
Right. He was a billionaire.
He was a billionaire.
Right. Yeah. And he made his money.
Yeah.
Not by being some, fancy hedge fund manager.
No, he made his money by investing in low-cost index funds.
Right.
And so, if it worked for him, it can work for anybody.
Right. So basically, if you can be patient, you can be disciplined, you can keep your costs low, you're going to do just fine.
You're going to do great.
Right.
Yeah.
Okay. So in a world of crypto bros and day trading TikTokers, Bogle's boring advice isn't just smart.
Yeah.
It's really the closest thing to a free lunch in finance.
It's true.
So think about it. How much of your time and your energy is spent trying to chase the next hot stalker? Perfectly time the market. What if a more effective and less stressful way is to just embrace consistent average market returns at a low cost?
Yeah.
So that's something to think about.